Shantanu Sengupta with us this morning is Chief India Economist at Goldman Sachs. Mr. Sengupta, always a pleasure to have you on. And this is such a timely report, a timely conversation to have, as we're just wondering what the India-US tariff is going to settle at. Now, from everything we've seen in the last 48 to 72 hours, is it now becoming clear at least that 25% is not the final rate we will see between India and the United States?
Yeah, thanks. So we think that, there's still some time to go, and possibly you could get a settlement which will be at a number maybe less than 25%. What we are unclear of is the penalty is unspecified on energy and defense purchases from Russia. So we'll have to look for that. We haven't made any changes to our growth estimates as of now. What we have done at this stage is put out sensitivities, which is easier for or more useful for clients to understand at this stage, pending the final official announcements. The final point is that they have been in deliberations for a long time now, and the U.S. team the Indian team has been in D.C. The U.S. team has been in New Delhi multiple times. So negotiations are still ongoing, and the Commerce Ministry also put out a press release stating that they're looking for a fair, balanced, and mutually beneficial trade agreement.
Shantanu, hi, morning. Alex here. Worst case scenario, are you building that in, that 25% stays? And if that is the case, then what is the implication for GDP growth? I see you've penciled in a 30 basis point drag. But is there any way that that can be mitigated because of domestic factors at all?
So I wanted to be clear that this is a sensitivity at this stage. We have not made any changes to our estimates because the announcement is not final yet. You're right that the annualized incremental impact, if you were to be at 25% tariff rate for all products, and then for steel, aluminum, and auto products already at higher tariffs, the blended rate would be around 26.5% in our view. This is taking out the unspecified penalties. We do not know that yet, so we have not incorporated any of that in. That would mean an incremental drag of 30 basis points on an annualized basis. What that will mean for about 5 months left in the year will be around 10 basis points. But as you know, the direct impact of these are more limited. The indirect impact actually comes from the uncertainty effect on investment. And there, from both top-down and bottom-up, we have seen an impact on CapEx spends by companies.
Shantanu, good morning, Neeraj here. And tariff issues notwithstanding, let's assume that the eventual rate is anywhere, as you said, less than 25%, maybe above 10%, whatever we settle it at. What's the slightly medium-term prognosis? 0.3%, 0.2%, whatever the impact on GDP might be. Just the basic building blocks with all that the RBI has done and the government is doing for consumption. There was a lot of chatter around how FY26 needs to be the year of the consumer as opposed to be the capex on the corporate side. How are you figuring the medium-term trajectory for Indian growth?
Yeah, thanks, Neeraj. So on the domestic front, we are quite positive on the bottom end consumer, especially. We think that there are multiple macro factors working in favor for the rural side, especially, and the overall mass urban side. One, the agricultural production has been quite good. Two, food inflation is down, which gives a boost to real incomes. In fact, real wage growth is nearing 4% on the rural agricultural side, which is at a multi-year high. And on top of that, you've had some fiscal transfers coming in at the subnational level, targeting women, especially in the lower income households. So all of that combined, we think can act as a catalyst for the rural and the mass recovery. And that is completely endogenous, so that it has nothing to do with tariffs or the rest of the world and what's happening on the export front. The part which we are a little more concerned about, as you said correctly, is more the capex side. And then if you put in together the 100 basis points easing by the RBI, the liquidity easing, all of that monetary policy easing feeds into the real economy roughly with a 2 to 3 quarter lag. So by the end of this year, or at least in the second half of this fiscal year, is when you should start seeing some of that effect. Also remember, the final point is that the fiscal has been big drag on growth in the last couple of years because it was consolidating by 80 basis points each in the previous 2 years. So you had a total 1.6 percentage point of consolidation. The planned consolidation this year is only 40 basis points. And that itself will be a lesser drag on growth than what has been in the past. So we would say that overall policy drag is lower, monetary policy is acting as a boost. So the domestic levers are looking better while the rest of the world, or at least on the export side, is looking as like a headwind.
Come to you on the assessment of India's GDP impact potentially to final demands of the US or the tariff number, because the number has been ranging around 2.2%. You peg it to 4% of GDP. Can the impact actually go that high if we don't come up finally with a deal which works for India?
And number is the Indian economy's domestic value addition associated with the US final demand. What that means in simple terms is that one, you can look at a direct export exposure, which is how much India is exporting to the US. Two, you can look at how much India is exporting maybe to other partner countries, and from there the final product is reaching the US. If everybody is getting tariffed, then you are impacted. You're impacted on aggregate. So in our mind, the number is closer to 4% than 2%. But the elasticity assumptions and all of that also goes into these calculations. We have found that about 0.5 elasticity is a good number to go with. There's an IMF study on that as well. And therefore, we think that the direct impact is going to be barely 10 basis points this year. If this stays at 25% tariff for the rest of the next year, which is quite an extreme assumption, I would believe, even then the annualized impact is only 30 basis points incremental. But as I said, all of this ultimately feeds in through the second round effects of investment uncertainty on growth. And there, you might have policy levers being put out. I mean, if really growth is seeing that kind of a drag, the risk would be that the central bank, the RBI starts easing a bit more than what is baked into our forecast, or you could have a fiscal which consolidates lesser.
Shantanu, the last couple of days, we've seen the slide of the rupee against the dollar. We're at 87.44 as we speak. I'm just wondering whether you have any anticipation as to where this pair is heading, particularly because in the recent past you've seen the strengthening of the dollar against a basket of currencies, and what that means for India in the context of the uncertainty of crude prices. We don't know where it's going right now. It's been more or less benign. But if it does inch higher, and if India is forced to, because of trade concerns, move away from certain suppliers of crude, does that have a bearing on the economy?
So the first point I would mention is that there's a confluence of factors which are working on the rupee at the moment. One, RBI has a large short forward book. Some of those deliveries come up. Two, you've been having some equity outflows, as you know, especially in the month of July. And on top of that, as you pointed out, there's been a slight bit of dollar strengthening in the past month or so. And that has caused the rupee to depreciate, but you've seen the depreciation across other Asian currencies as well. And rupee would have been in the middle of the pack as the overall Asian currencies depreciated. Look, our house view still remains of a weaker dollar in the medium term. So we would treat this as an aberration. We think the dollar slides weaker over the next 6 to 9 months. And therefore, we are not really baking in a much sharper depreciation of the rupee in our forecasts. But as you pointed out, if you have a scenario where oil prices are higher than the sort of $70 range that you're seeing now, and the dollar continues to strengthen, which is not baked into our forecasts, that would mean a weaker rupee, and that's also the right adjustment mechanism for the economy when you're going through this kind of a tariff episode, right? So if tariffs are imposed on you, you're having a slower growth. One of the ways of policy to react would be to have a slightly weaker currency in that case.
Shantanu, always a pleasure speaking with you. Thanks so much for the clarity that you brought this morning.